How's it going out there? It's Tuesday, June 21st. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. I woke up on Monday, put on CNBC, ready to see what the markets are doing. Figure they're down a ton since they've been down like every single day since it was 11 of the past 12 weeks. And Shark Tank was on. I was like, what the hell's going on? I had no idea it was an actual holiday. Juneteenth. I do like 3-day weekends, even though I was working yesterday. But learning a lot about Juneteenth now. It's a holiday and celebrates emancipation of enslaved African Americans, going back to 1865. So now it's the longest running holiday, which is celebrated in Texas. But, yeah, I was just surprised. It's the first year they're celebrating it, that it's a national holiday. So I woke up, I had no clue that all the banks closed, everything's closed, markets closed. And again, doesn't mean I wasn't working hard, but just learning more and more about that holiday. As people celebrate it, which, listen, it is what it is, and that's cool. I don't know if I would ever put a giant 24-foot-tall afro hair pick with a black fist on the handle in Lafayette Square, New Orleans. That's the mayor actually did. I mean, I don't know. I think that's kind of insulting to black people anyway. But what crazy times. I just feel like you're watching, even when you're watching the CNBC, you're watching, I just feel like that there's such separation here. And it's hard not to get involved in it. I think people are forcing racism. But even some of the policies that are going on, which we're seeing, and the reason why I bring this up, not political, I know this is an investment podcast, but I want you to try to learn of how to play these things and play these big political themes, because they have serious implications for where you're investing, where money is flowing, what country. And that's what we're going to talk about later, because I want to talk about the state of the markets, which it's pretty insane right now. I mean, inflation obviously is still taking center stage. We all know it continues to increase. Me personally, Father's Day was great. Hopefully all you guys enjoyed Father's Day. My two experiences, went to one restaurant I like to go to, and they didn't have, my daughter liked nachos. They didn't have nachos, mozzarella sticks, or pizza skins. It was like out of 7 appetizers, I think they didn't have 5. Went to Cold Stone the next day. My daughter wants some ice cream. I said, sure, no problem. But my 11-year-old went away for the first time to basketball camp, so she's away from us for 3 days without her parents. Big deal for us. I'm sorry, that's my 14-year-old, which is, a little weird. She was nervous, really, really cool. But, so we spent some time together on Sunday, and she's like, hey, can we get ice cream? I said, sure. And they're out of, the large cups, and, we didn't order a shake. She got, a small ice cream. I didn't get anything. I've been eating very good lately, at least trying. But they couldn't make large shakes. They didn't have the cups for large shakes. I mean, so you're still seeing supply chain concerns. You're still seeing major labor issues. We'll cover that in a minute. That's a huge concern. It's a concern because I can't figure it out. If any of you can figure it out, frankcurzioresearch.com. I'm trying to figure out why, when you look at the workforce, why nobody wants to work at these places anymore, whether it's restaurants, it's services. And almost every one of them is struggling. And some of them are, they're raising prices. They're offering much better pay. But since COVID, there's been this shift. And I get it when you're getting paid money through the government, but that stopped. So where are these people? Where are they working? Why can't people hire anyone? And that's major, because what are companies going to do? But obviously, if you're getting busier, it's going to result in worse service. So you're going to have to raise prices even more, which we're starting to see. People are closing their wallets. We saw that with Walmart and Target those warnings came so sudden, and then, 3 weeks later, to Target won again. The margins are going to get hit because they're sitting on massive inventory, 35% across the sectors, right? They saw all this crazy demand, and they couldn't get supply, so what did? They over-ordered. And then demand fell off a cliff, and you saw Target and Walmart fall by the worst amount in a single day since 1987. Are you kidding me? 1987. That's how far those stocks fell. So you're seeing people shrink their budget, they're closing their wallets. They're seeing this, especially with energy, $5 a gallon gas on average across the nation. Food prices through the roof. So a lot of negatives. And you're putting on CNBC, and I want to put on CNBC and Fox Business to gauge sentiment of what people are saying. And everyone, 100%, there's no one on there that's telling you to buy stocks. If you listen just for an hour, and the analysts coming on and comparing and showing their notes, and, they have data and stuff, which is okay, and I'll break it down and tell you why a lot of it's full of shit. But you're listening to it, makes you want to throw yourself off a building. It's going to get a lot worse. It's going to get a lot worse. I mean, where were these guys like when, in November and December and January when the Fed, obviously was saying, hey, we got this wrong. It's not transitory. We're going to have to aggressively raise. Where were you? Now you're seeing stocks sell off and we're in a bear market, technically a bear market. But I mean, stocks have sold off significantly outside the S&P 500 and risk assets. But you're just watching that. It's crazy. And they're bringing up some data points, valuations of past major recessions, saying we still have another 30% downside based on, what the PE, average PE is during recessionary times. Comparing those multiples, past bear markets, when you're coming off those, huge bullish conditions or long bull runs, the S&P has fallen between 20% and 33%. During these crashes, and we're down, 21%? So, they're saying, on average, I think it's 27, 28%. So, we still have some more room on the downside, which is, okay, I get it. I see what you're saying. But what's not being mentioned is they're just comparing the S&P 500. Not comparing all stocks. But if you look at the Russell's down more than 30%, you look at risk assets. Holy shit, SPACs, IPOs, growth stocks. These names are down 60% plus. What's holding up the S&P valuation is you have trillion-dollar companies that are still getting it done. You're going to see these massive sell-offs in Apple, Microsoft, Google. They still control the world. So can we look like as apples comparison and say, well, this normally happens? Because when you look under the hood and you take out some of those big names and then you throw in the SPACs, the IPOs, growth stocks, holy shit. We've never seen anything like this. Anything like this during a bear market period that's not a black swan event. Not like the credit crisis or COVID where we saw everything absolutely crash. Markets like this, when we saw .com, it was technology falling 70, 80% and bottoming the NASDAQ. But you're seeing a lot of these companies down that much. Again, the NASDAQ is filled with a lot of those big companies and trillion-dollar valuations. So you're not seeing it that bad when you look at the major indices. But looking under the hood individually, holy shit. Total risk off the table. Total risk. Why? Because we're seeing the largest deleveraging process in history. You're seeing trillions, absolute trillions be removed from the market. Bank of America publishes these numbers, and I think it's like 30% of all the money or all the easing, which is, I forgot the exact number, but I think we're up to about 23 billion or something, or how much we account for that. And it's incredible. It's incredible how much we get, 30% of it. It's insane. And we're talking trillions. When the market was fine in 2021, when assets got back to record highs, we're still printing like idiots. And we still wanted to pass the Build Back Better bill. Thank God for Manchin. Holy shit, imagine where we would be in terms of inflation. We'd be at 12, 13%. That's several more $1 trillion of printing. Now we're taking it all out of the system. That's what the Fed has to do. So what's concerning to me when I see, a lot of these guys get on TV, but let's talk about some of the concerns. Again, this isn't going to be like the fun podcast. This is going to be like how to position yourself and what I'm doing. And pay attention, because this is going to make a lot of money. Please pay attention to this. Try to make it as interesting as possible, because I know. I mentioned some numbers, not crazy numbers. But you look at estimates, they're still way too high. Starting to change a little bit. Wall Street started lowering their earnings estimates, GDP estimates, and 2023 GDP forecast for Evercore and a couple of others, I think they went from 2% to 1%. The White House still seeing 2.5% growth next year, which we're not going to see. We're not going to see. But it's funny how economists got this so wrong, and it's such a difference between an economist and a market analyst, where they're concerned, recession. Are we going to see a recession? We're not going to see. Who the fuck cares if we see a recession? And the only people that care is the White House. It's political. It's a great headline. I get it. I understand. But if we see 2 quarters of, and again, recession is defined as 2 negative quarters of GDP. So say if we get growth of 0.1% and 0.1%, isn't that a recession? I mean, technically, it won't go on your record if you're the president during those times, but, that's what you want to try to avoid. But the Fed is forcing this. They have to force a recession. That's what they have to do. We've been saying it for over a year. The Fed has to force a recession. They take money in the market. It's dangerous because it's the first time in 12 years where the Fed's not there to bail you out. So we're heading into a recession. The Fed is forcing it, and inflation is that high. It has to force it. That's what they do. And if you're wondering whether we'll be in a recession or not, look, in the last 15 hiking cycles, 11 were associated with recessions. We're going to be in a recession. Again, makes for a great headline, but for investors and individual investors, it's not a terrible thing. Recessions used to be normal, but the Fed didn't allow it since the credit crisis. Kept rates low, buying treasuries, pushed more money into the economy. I mean, it's a bailout. You got it. Those days are over. We used to get a recession, every 5 years? And it's good because it wipes out all the bullshit. While survivors, those good companies, tend to grow considerably in the years after. Since they're taking all that market share from the companies that went bankrupt and did not survive. We saw that during the credit crisis. We saw it during the dot-com bubble. We see that in past recessions. And we're seeing it now. I mean, look at crypto. And all these crazy lending companies. It's something that I spent 3 months trying to understand and talking to people, and I still couldn't. How do you pay 12, 13, 14, 15% interest? In order to be paying that, you have to be making more than that. And how do you do that? Well, if crypto prices are going high, maybe that's the way, but nobody shows the balance sheets. Nobody shows anything because these things aren't deemed securities. You don't know if they have cash on a balance sheet. So you see a company like Celsius, huge lender. There's big hedge funds blowing up now. I mean, the leverage in this industry is insane. And if you look at the credit crisis, that was DeFi at its best. That was DeFi at its best. You say, well, there was regulation. Nobody knew what the hell was going on. The Fed had no clue what was going on. I mean, exposure to AIG, how long did that take? I mean, if they really knew what was going on, they wouldn't let Lehman fail. They had no clue what was going on. It was all like, under the table shit, leveraging. It wasn't subprime debt that crushed the markets. It was the leveraging of 30, 40, 50 times and synthetic loans and all this crazy shit off of those subprime mortgages. That's what crushed the market. You need a 5% downturn in home prices, the whole market was going to crash. That doesn't happen if you're not on margin. So that's what you're seeing it where, a lot of these companies were tens of billions of dollars in crypto and all this lending bullshit. You're seeing them unfold. And they do hold what? Bitcoin, Ethereum on their balance sheet, which they're being forced to sell. So you see those two biggest cryptocurrencies get nailed. I mean, look what happened this weekend. Ethereum fall like 800 or something, 900, and then Bitcoin was under 17,000, and, both recovered over 20% from those lows. But that's what you're seeing right now. So, and even in our markets, right? You're wondering why. Hey, I got good companies that reported decent earnings, and they're down 25%. Why? It's because it's the leveraging process. So anybody that's looking at stocks right now, it's not, the bottoms-up analysis. Wow, this company is cheap and growing here. It doesn't matter. Right now, it's a macro story. We need to see a bottom first, and I think it's going to happen a lot sooner than people think. I mean, you don't have this uncontrollable inflation where you had it, but these companies don't have pricing power that goes forever. There's a certain price that people are going to be like, fuck it, I'm not paying that, and we're there. We're pretty close to being there, where people are changing their habits, and you're seeing that at earnings. You're seeing companies lay off workers right now. You're seeing that across the board, which is a good sign. I mean, Target and Walmart telling you that they're lowering margins are going to get hit because they have to lower prices because inventory is too high. That's the first deflationary sign I've seen probably in 2 to 3 years. That's a good thing. That's what we need to see. But getting back to the Fed and recessions, again, it used to be normal every 5 years. And the Fed chooses not to allow it after the credit crisis, and now all of a sudden you reverse course. People forget when you don't have the Fed there, holy shit. And it's an unlimited printing press to save the world, keeping interest rates low. Now you don't have that. As interest rates go higher, it makes borrowing more difficult, which means you're not going to have that money to pay for certain things, right? That money that you want to buy new stuff is going to shrink, right? That amount is going to shrink, which means you're going to focus on things that are important to you. And that's how you have to look at stocks. It's almost like looking at a social media company. Right? Everyone's fighting for your time. That 5 extra minutes that you're going to do something. Is it going to be TikTok? Is it going to be Netflix? Is it going to be Facebook? What's it going to be? And that time, that 5 minutes results in, $100 billion, $500 billion company, sometimes $1 trillion company. Depends. Depends how long you're staying on there. They could charge advertisers, but they're all fighting for your time. But looking at the markets today, we're getting a nice rally, which shouldn't be surprising. Shouldn't be surprising, this rally. I mean, the bull bear indicator from Bank of America, and a couple of companies track this, but this measures like a dozen technical indicators, the breadth of the market, option activity, and VIX and all that, right? And it throws it into this indicator, and it goes from 0 to 100. And it's a contrarian indicator. So extreme bearish is 0, meaning that you should be buying stocks if it's 0. Very, very, hand over fist. And if it's 100, that's a bullish reading, meaning you should be selling stocks. Right? Because again, contrarian indicator. The reading between this, you'll usually see between 20 and 80. It's 0. It's at 0 today. Or actually before today's open. So during the weekend, it was at 0. 0. It doesn't get more bullish than that from a technical standpoint. That means the whole world is leaning towards one side. All these shorts, you just need a little bit to happen, and boom, you get in a nice market rally. That may change. I'm doing this at 10:30 right now today. It may change. Maybe we fall. Again, every rally has been met with selling. It's not a buy to dip market anymore. It's more like sell or rips because of all the confusion and no certainty around inflation. We're likely to see that again. And that confusion, that's what it is, the uncertainty. I mean, people are worried that inflation's never going to come down. They're still going to have supply chain concerns, labor issues. We still have that. Russia, Ukraine, when's that war going to end? Which is leading to higher energy and food prices and supply chain concerns in those two industries. So that leaves the question, do I just get out of the market, stay in cash? Is this crazy? Hold on a minute. Just keep listening, just for a little bit longer. So people ask me, Fred, what are you doing right now? I'm getting out of the market. What are you doing right now? What are you doing right now? And for me, it's I'm going golfing more than ever, going to happy hour, getting drunk. I'm just kidding. I'm not doing that. I'm actually working harder than I've ever worked in my career. And the reason is because, for me, I'm a guy that focuses on mistakes. That's how you get better. And my biggest mistakes was not getting more aggressive during times like this. I'm not saying I'm throwing every single penny I have in the market, but I'm picking away and I'm buying here. And these major pullbacks that you're seeing, and forget about the 20% in the S&P 500, and it usually goes down 27%. Again, you look under the hood, there's names down 70, 80% that are decent names that you'll find. But I want to be more aggressive when times are shitty because they don't happen often. I mean, think about it. Think of the long-term buying opportunity. Think of the 87 market crash. By the way, the 87 market crash, largest on record at that time, massive one-day crash. The Dow finished the year higher that year. That's interesting. Think about the dot-com crash in 2000. Great opportunity. Buy tech stocks. Yes. 2001, 2002, 2 years you're sitting there and shit, it sucks. Think about 4 or 5 years from now. That's how you should be thinking as an investor. I know it's hard because everything's today, tomorrow. Oh my God, everything's like right now, right? With social media, send an email, some person in China opens it up in a half a second. Less than that. I know everything's immediate and everything is designed to scare the shit out of you, like they did with tariffs, like they did with so many different issues over the past 10, 12 years that probably kept you out of the markets when you shouldn't have been out of the markets, with the Fed keeping rates at 0 for almost the whole period outside of, 2016, 17. And buying bonds and flooding the market with cash. You should have been in the market. Everything was going higher. But again, everything's going to amplify. You watch it, the headlines, you see everything in social media. It's right in front of you. That's why you have young kids talking about racism, critical race theory, and politics. I didn't know anything about politics until I was like 25, 27. I mean, my daughter, they had CNN on in a fucking classroom when she was 13. So I pulled her out of the school. I don't care if it's CNN or Fox. Why do you have that shit on in front of kids? Are you kidding me? With all the bullshit? I mean, it's a different world. Everything's in front of you today. You see everything. So it scares the shit out of you. And that's okay. But think about your 401k and long-term holdings. And yes, you're looking at it being like, wow, I'm down right now. It's getting killed. Yes, but, if you've been in the market for the last 10 years, you're up considerably still. But these times like this, when the market COVID, 2008 credit crisis, what happens? Look at those buying opportunities. I'm not saying to go on margin and buy everything in sight, but here's here's what I'm looking at. I'm looking at China. You don't hear me say that often, do you? I know people tell me buy China for decades and decades and decades. But right now, China's kicking our ass. They're producing so much cheap energy, so much coal. They're stockpiling everything. Yes, we see places that are closed in Beijing now with COVID, but it is opening. You're starting to see reopens. And it's an economy that is much, much better shaped than we are. That's where the growth's supposed to take place. The world growth. And stocks have never been cheaper. But they're light years ahead of us. They don't deal with this ESG bullshit where, I don't care. It doesn't matter what the macro conditions are. No more fossil fuels, right? That's what our administration ran on. That's fine. You could say they're opening up federal lands, which is bullshit, right? You saw the Exxon CEO on TV just ripping apart the administration about how much money that they spent. And again, they're going to tax them and do anything. Whatever. We have a alternative energy, which, again, alternative energy, climate change, serious things. But, at times like this, where energy prices are, let's produce as much as we can and throw some of those profits into alternative energy. Because right now, China's laughing at us. Venezuela's laughing at us. The Middle East is laughing at us. Everybody's laughing at us because we're a complete joke. And we're losing power when we have the greatest and most powerful commodity in the world. And it wasn't like that ever until 2009, 10, 11, fracking, hydraulic technology, and drilling, horizontal drilling. That's, again, studying that tremendously and going to all these fields throughout America. I mean, I've learned so much about it, but come on, let's produce this. Let's lower energy costs, because right now, someone else is producing coal, and that coal is going to damage the environment just as much if we produce it here or if China produces or we produce someplace else. But it makes their economy much, much stronger. But when I'm looking at China, man, they're set up great right now. Looking at the price of these stocks and how much they got nailed, China is, I'm looking at China for the first time in a very, very long time. Maybe ETF, the large caps, don't go into crazy stocks. I've been to China. I got screwed once before with small caps. I saw an amazing company, which happened to be in the coal industry, and saw their assets personally. Unfortunately, they sold those assets like 3 years ago and never told anybody, which is great. It's China, the most corrupt nation in the world, just about next to Ukraine. But it's insane when you look at that. But look at large caps, guys that are reporting. China is a great place right now to invest in. I'm looking at stocks that went public via IPO, SPAC, over the past 18 months. So think about it. When a company goes public, what do? They raise a shitload of money. And in the past 18 months, because we had some of the bullish market conditions in the history of our country, they came out at stupid, ridiculous valuations. And they sold us to the public, and the public got destroyed. Crazy, crazy, insane valuations they should have never came out at, but that's fine. Good for them. They raised a lot of money. They were able to sell some of their stock. Now these things are down 70, 80%. They still have that growth, except you're not paying 50 times sales, 75 times sales. Now it's more like 10 times sales, 8 times sales. And what do they have? They have extremely strong balance sheets with tons of cash on the balance sheets. So they still have that growth. Maybe it's a little bit slower. Instead of growing like 60% because they're smaller companies, or 50% or 40%, they're growing 25%. They're going to grow earnings. And now you're seeing these valuations come down tremendously. They're sitting on massive cash balances that account for more than 50% of their total market cap. No debt on a balance sheet. These are names that I'm looking at, because some of those names are great. They're great companies that came out. Some of them, they just came out at stupid valuations that it was a joke. And a company with $1 billion valuation should come out at $15, $20 billion valuation. It's insane with the Coinbases and the Robinhoods. Great ideas that change the landscape of industries. But should they come out those crazy valuations? No, absolutely not. So that's where I'm looking. Again, you have to look today. Stop looking at the past. All this shit, these companies are terrible, CEOs terrible, all this shit is garbage, all of that. You have to look at today. Try to forget about everything that happened and look today, like a fresh look. And that's hard to do if you own these stocks in the past and got killed. It's really difficult to do. But you want to take a fresh look at these names. But man, how many are down 75% plus from their highs, still growing? Again, 50% plus of their market caps are in cash. Might pick away at a couple of those. I'm also looking at companies trading below 10 times forward earnings right now, which is a lot, that are also growing earnings more than 12% I have on there. Then I'm doing an even deeper dive. So it's not just I want to buy cheap companies because cheap companies get cheaper. I want to see the growth, but plus I want to see some of these companies are raising the dividends. Let's get a dividend more than 2%. That's nice. And then you're seeing insider buying. I mean, there's more insider buying taking place right now. It's almost near record highs, like back in the credit crisis. Again, these insiders are buying. It doesn't mean that stock's going to go higher. We've seen over the past couple of weeks they've been buying and stocks have sold off. But the fact that they're buying their companies, that's a great sign. And these guys aren't buying okay, I'm looking to buy and load. These guys already own their stock and talking about notable purchases. I'm not talking about 10% owners of hedge funds, of other people's money. I'm talking about CEOs, CFOs, people associated with a company that are making $1 million plus purchases. Those are huge, huge purchases. They could do, very, very wealthy people, they can do whatever they want with their money. They're buying their own stock at these levels. That's what you want to see. That's awesome. And again, they're not looking at it as, well, maybe the market and inflation continues to go higher and, we see another 15% downside. They're saying in 2 or 3 years from now, this is going to be worth a lot more than where I'm buying it right now. So much so that I'd rather do this with my money than anything else and buy a house, buy other assets, buy other stocks. And these guys know exactly what's going on internally with their company and they're buying. That's a great, great sign. Again, doesn't mean it's the bottom, but I'd rather see them buying than selling with stocks with its stock down 30, 40, 50%. I'm looking at reopened names. They took another hit. But airlines see revenue back to pre-pandemic levels, and earnings are going to explode for these guys. The international markets are starting to open up. They've opened up already, but now people feel more comfortable traveling country to country, which is huge for companies like Delta and United and American. It's great for Vegas casinos. They're still seeing strong demand in the hotels and rental-car companies. But you're seeing a shift. I talked about this earlier, where that pile of money gets smaller and smaller that you have, and where you're looking to spend it. Well, it used to be on these discretionary items, the Five Belows, or whatever. And that's where Target and Walmart said it surprised the hell out of them with discretionary spending, how much has been cut, where instead of buying these physical items, they shifted. And they're shifting to experiences and services. And we're seeing that across the board, and there's a lot of data that supports that. Which tells you that those reopened names, which you don't really say reopen because they've been open for over a year, especially in Florida. But man, even cruises are starting to look attractive. And retirees love to take cruises. They're going to continue to spend money on cruises and spend that extra money on cruises. A lot of these names got hit. You're going to see earnings for these names and revenue for these names go significantly higher over the next 12 months. Even if we have a recession, which we're kind of in a recession right now. So it's, where is that pile of money going to that you have? How much is going here? How much is going there? Because it's shrinking, but still, you're still going to spend on things that you love to do. And right now, it's, hey, I want to go away. A lot of people still haven't gone away since COVID. They're willing to spend an extra 30% on their flight, 20% on their hotel because they haven't gone away in a couple of years. And you're seeing that. You're seeing that across the board. And then you look at the big money and the flow that's coming in. Money's flowing into equities right now. Seeing one of the biggest downturns in bonds that we've ever seen. Global yields, global market. Down more than it's ever been for the first 6 months of the year. It's insane. But money in the past 3 weeks has been flowing into equities. And you know what's taking up the most of that? Surprisingly, you would think large caps and value. It's small caps. It's small caps. Why? Because it's down 30% compared to 20%. Large caps. Now, and you're trading, and you look at the sell-off at 31%. If you compare it to other bear markets, that's worse than the previous 8 bear markets. That's the Russell. And you look at valuation, it's trading at 16 times earnings. When all those bear markets, when you compare the past 8 bear markets, they previously bottomed at 15.7 times, right? 16 times. So risk-reward for small caps right now has almost never been greater. And I'm going to show you why it's almost never been greater in the history of the Russell. And I'll show you if you're a Curzio Venture subscriber, which you're going to see tomorrow. Make sure you watch that video and the stats I provide for you. You'll be blown away. And it's not cherry picking this, which I see on TV. I'm cherry picking this, and usually, if you want to really count and look at previous bear markets, the S&P 500, you can't say, well, this one's down 20%, the average is down 27%, so we have more of a downturn. If you take out the largest stocks, it's comparable to almost the biggest downturns that we've seen. And most people are feeling that because most people are not down 20%. If you own the S&P 500, you're down 21%. Most people are not. If you own individual stocks, you're down a lot more than that. There's a lot of good names. Anyone who is speculating, which you should be speculating with a small portion of money at all times, no matter what age you're at, that could be 1%, that could be 25% based on your age, but you should speculate with the chance of making more money than you ever dreamed. It's not a billionaire in this world that said, I became a billionaire without speculating. They don't, I bought these conservative things. And don't put Warren Buffett in there. He's the biggest speculator ever. And the amount of leverage that guy took when he just, the reinsurance and the insurance companies, and this way he could leverage those massive pools of money. Brilliant. But don't tell me, he got that rich because he bought and held Wells Fargo and Coca-Cola. Bullshit. No way. I mean, he was smart when it came to leverage, when it came to debt. Knew how to take on risk at the perfect times. But anything you speculate on is down tremendously over the past 7-8 months. But I'm very bullish, especially on small caps. You're not going to hear that anywhere. I don't see anyone, literally anyone, anywhere talking about being bullish on stocks. And that's a good thing. And they're citing all the risks that you already know. Inflation, food prices through the roof, energy prices. When's it going to stop? The war, Russia, Ukraine, China lockdown, supply chain concerns. When you have to worry is when they're talking about shit that's not on the table, like 2008. Again, the Lehman bankruptcy, AIG insuring all this stuff that nobody knew about. All crap under the hood. We're seeing everything right now. But now you really see what's under the hood in crypto. Absolutely. It's crazy. All the leveraging. Again, that deleveraging process is crushing a lot of names. That's where all the innovation is coming from. It's more exciting than ever, but it's extremely painful, and I get it. But it's going to make that industry much, much stronger. Also, insider buys, I mentioned earlier, coming in at a pace we haven't seen since the 2009 credit crisis. And then you have the midterm election cycle, where the second half midterm until the first half of the year. So you're looking from November, maybe a 7-month period, 8-month period, into year 3. When you look at the S&P 500, it's up 81% of the time. Because now usually you have a split government, which is the best government to have. You never want on any side to own everything, because then you get 100% of an agenda. Everybody gets greedy and stupid, like we've seen, like we just recently seen. Here's the keys to the kingdom, and look what the fuck happened to our country. And the same thing when it comes to Republicans. Same thing. You don't want that. As an investor, you don't want that. It's usually the worst times. So what happens with those midterm elections? Usually the side that lost comes back into power, win the Senate, win the House. It's going to be really nasty for Democrats right now, just with the economy in general, how people usually vote. And that's usually good. But 81% of the time, the S&P 500 is up after midterm elections, November, into first half, year 3. So when you're looking at everything is horrible, inflation, right? When you look at inflation, people are quoting, and this is an interesting stat, which, is very scary, scares the shit out of me. But when you're comparing this inflation every time, you compare it to the 80s and maybe one other time. But the Fed funds rate, and this is how they broke this trend of this massive inflation, is they brought the Fed funds rate higher than the inflation rate. The inflation rate's over 8%. The Fed funds rate is 1.75%. Think about that for a minute. However, that's what the 10-year 3.2% is telling you. That's what the mortgage rates are telling you, that we should be much, much higher than the Fed funds rate, well over 3%. And we're going to see inflation moderate a lot faster than people believe. It's going to take a little bit longer on the food front and the energy front, and I get it, I understand. I covered those statistics and told you why. But overall, you're going to see people start closing their wallets. You're going to see prices come down, and you need them to moderate. Now, moderate means $5 for gasoline prices going down to $4.80, which is still crazy expensive as that average rate. But you need to see it moderate, because when you see it moderate, that's going to tell the Fed, okay, we don't have to go nuts with 75 basis point hikes anymore. And that's going to be a boom to the market, which is down considerably. And you have to look at the market, guys. You have to look at stocks. It's shitty right now. And that's why your portfolio is down 30, 40%. And some of your 401ks. A lot of this is being factored in right now. It's the surprises going forward. Everybody thinks inflation is going to keep rising. 6 months ago, everybody thought it was going to moderate. That's what the Fed was telling us. Now we're like, holy shit, how do we control it? Everyone focusing on it. You're going to see it come down a lot faster than people believe. And when you do, that should provide a bottom in stocks. I don't know when it's going to happen. It could happen 2 months from now. It could happen 3 months from now. It could happen 6 months from now. But I do know the stocks I'm looking at in my game plan, which you're going to see in our newsletters, it's where I'm looking to buy stocks and position myself, because when this thing does bottom, and it will, we're going to have massive gains a couple of years from now. And that's how you should be looking at it, working harder. So prepare yourself. And working harder than you ever did to find new ideas. A lot of times just simply throwing a towel, I'm done, I'm in cash, F this, I can't take it no more. No, don't do that. That's the biggest mistake I've made in my 30-year career. When you see these types of markets, you should be looking at how to position yourself to make very, very easy money when things turn. And they will turn. They've turned for over 100 years. If you look at the chart of SP 500, where's it go? Almost up, 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 up. Yes, you're going to have periods like this, and it sucks right now. But with the whole world bearish, stocks down as much as they're down, the Russell 2000 trading at valuations we've never seen ever in terms of growth, ever. And again, Curzio Venture subscribers, please take a look at that video tomorrow. You're going to be blown away by some of the statistics I'm going to show you and why I'm getting aggressive buying really quality small cap names right now. Many names are on sale. And you take out those 2 months from the COVID crash, we haven't seen valuations like this in overall, in the overall market, not just small caps, overall in over 10 years. It's good. Now, inflation moderates when the Fed stops raising. If you're waiting for that to happen before jumping back in, you're going to miss a major, major move higher. A major move higher. You want to invest before that. At least start picking away, taking small positions. Companies are probably going to lower their estimates into the quarter. A lot of that may be factored in. If it's not, stocks pull back, you can add to your position. It's fine. Like I said, I'm buying here, knowing that it's not the bottom, but that 2 years from now, the names I'm buying are going to be significantly higher compared to the price I'm buying at right now. So, guys, that's it for me. Questions, comments, I'm sure I'll get a lot. FrankCurzioResearch.com. I'm here for you. Back to normal schedule. Going to have Daniel coming on tomorrow. So, again, we'll answer some of your questions. Send them in again at FrankCurzioResearch.com. I'll see you guys tomorrow. Take care.